Transfer pricing is the term used to describe the pricing of transactions that take place between related companies that are part of the same multinational group but reside in different countries. In this presentation, we highlight real issues that can be faced when related companies work in the cross-border environment. PwC's Western Canadian transfer pricing leaders delve into how to comply with complex transfer pricing rules and ensure that your dollars are only taxed once.
The fight for your tax dollar is a real one. It's one that's going on in the BC Lower Mainland as we speak. As CRA auditors are out in businesses conducting transfer pricing audits across BC. It's happening across the border in the US, where the IRS auditors are extremely active these days. And it's happening in around over 70 countries around the world that now have transfer pricing rules that have been introduced country by country, spreading around the world. Each country introduces transfer pricing rules for the main reason to protect their domestic tax base. So it's a protective measure that many years ago, many say it was started by the US, who first saw intellectual property and value being moved offshore, and the profits and taxable profits of that property moving offshore with it. But it's a tide that is spreading around the world, and if you're doing business internationally, you should expect that you are in countries that do have transfer pricing rules these days, as tax authorities are protecting their tax base. The consequence of countries protecting their tax base is that the cost you face as financial executives potentially is an unacceptable cost of double tax. And what we'll talk about today is how that can impact you and the steps that you can take to avoid that, because that is a real and unacceptable cost to your business. So our objective in the next hour or so is that by the time you leave here today, you'll have a really good understanding of why a complete and thorough approach to transfer pricing will be really good for your businesses. It will be really good for your tax and finance teams, your staff and your resources. And it will be really good for your stakeholders, whether those stakeholders are public shareholders or whether those stakeholders are individual owners of your companies. So there's a number of aspects to this that you can take away, and these things will be good for your business. So before we go too far, I guess we better make sure that we're all on the same page about what is transfer pricing. In the context we use the term transfer pricing, we're talking about transactions between companies within a multinational group. So it's a transaction between two companies. And in the context we generally talk about it, those two companies are in different countries. So, for example, Canada, US. Transfer pricing does also become an issue between companies in the same country. So you should be aware of that. For example, the UK has rules about transfer pricing which apply within the UK. The same is true of a country like Portugal. And if you look across to the US, there are transfer pricing rules that apply state to state. So while we're generally talking about across an international border, just be aware that we can be talking about within a country. And the other thing, a general high-level point for you to note, is we're talking about related companies within a group. That definition of what is a related company does change from country to country. So different countries have different rules about what constitutes what we call a related party transaction. So in Canada, it's a reasonably clear definition of control. So we think of more than 50% ownership gives you a related party transaction with that company. We can go further than that, but in general, that's the principle. In the UK, a cross-border related party transaction is relevant if you've only got 40% ownership. So just be aware that what you think of control might not always be the simple rule. So the key is that those transactions between those companies have to be conducted at arm's length. This is the rule. And this is the overriding rule. And what that means is that the price of those transactions should be what arm's length parties would agree to. So you have to transact as if you are unrelated. which means, I know, putting yourself into a parallel universe where you have to picture a relationship a situation where you are unrelated to that company. So it can be tough, but that's the rule. And then let's talk about the transactions that are involved. It is any cross-border transaction. So we're talking about tangible transactions where goods are flowing or equipment. We're talking about services, which can be a broad spectrum, whether it's an R&D service, a back office service of some sort, manufacturing service, any service. The area of intangibles, so royalties and license fees. So if you've got intellectual property that another company in your group is using, there will be a cross-border transaction perhaps for that. And then finally, financial transactions. And these are transactions that I would say 10 years ago were not a big focus for transfer pricing practitioners and tax authorities, but that in today's climate is completely changed. I would say financial transactions are very much a hot topic in today's world of transfer pricing. So we're talking about intercompany debt, the interest rate on it, the amount of it, guarantees related to intercompany debt, and guarantees related to intercompany operations, for example, and cross-border factoring arrangements. So as you can see, we've got a very broad spectrum. And again, going back to that pre-session survey, we got a very, very even response rate across those 4 categories of transactions. So again, I know that all of these 4 transactions are relevant and interesting for you in the room. So again, write down questions if you have interest. So why should I care about transfer pricing as a finance executive? Probably a good idea just to reflect that I know for finance executives of multinational groups, what I often hear is, well, it's all eliminated on consolidation. So why do I need to care? Well, the thing about transfer pricing is there are aspects of transfer pricing that are not eliminated on consolidation. The costs of getting transfer pricing wrong might survive. So, for example, if in a transfer pricing adjustment, the actual adjustment might get eliminated on consolidation or resolved in some way, but penalties, interest, and withholding tax can be actual cash costs to the business. So just beware of the eliminated on consolidation sort of kickback there. There can be a cost, and you need to be aware of those costs. And the other cost that I'd like to draw your attention to is the resource cost of in your business, the time that you and your teams will spend on dealing with transfer pricing, which will be much more intensive and at a time that you can't control if you're spending that time in a dispute. If that resource time is spent in planning and documentation, you will control the amount of time that's spent, you will control the effort, and you will control when that time is spent. So again, managing your resources, be aware of the drain on resources that a transfer pricing dispute can be. But let's be a bit more positive, though. There are benefits to be reaped from approaching transfer pricing in an orderly fashion. Transfer pricing has this concept of the arm's length principle, and one beauty of transfer pricing is that we have a concept of the arm's length range, that there's not one single answer to every transfer pricing problem. And with a range, we have flexibility. In your businesses, you also have some flexibility about how you organize your business, and if you're going into a new country, you've got some choices to make and some flexibility about how you set that business up. I should say that planning is an area that we love to work in planning because we like to be in the positive zone of taking opportunities. And just caution that planning done well is good. Planning that doesn't have good substance to it can cause you to be in the papers. So just a small caution that to make sure that your company is going to be in the papers for the right reasons for successful businesses. But you've probably all heard about some of what's happening in the world, particularly in the US and in the UK, a lot of focus on transfer pricing as a so-called iniquitous practice. In the UK, taxpayers, the media, and Parliament itself are scrutinizing the tax authorities, HMRC's activities on avoiding, letting companies avoid tax. So that aspect of public scrutiny is something that you need to be aware of. And you need to be aware that your boards and your audit committees are aware of this news as well. Because audit committees may be asking you, well, what are you doing to take advantage of some of these opportunities? Have you optimized your effective tax rate? Have you become the hero in your organization by moving the effective tax rate down? Or are they going to be asking you, are we doing anything that's overly aggressive? Is our tax structure and our transfer pricing model defensible? And are we paying the right amount of tax in all the countries that we're doing business? So there's a lot of scrutiny around the world. NGOs are writing papers about the taxes that multinationals pay in African countries and whether the right amount of tax is being paid. So there is a global media debate about tax and transfer pricing for you to be aware of. And just bringing it back to Canada, that scrutiny of authorities, obviously in Canada, the Auditor General scrutinizes what the CRA does. And from the 2011-2012 report on the CRA's activities, we learned that $5.6 billion of missed tax was captured through audits of international and large businesses in that year. $5.6 billion. Now, that's not all transfer pricing, but we know that a very large proportion of it is. And if even 50% of that was sustained on appeal, that would be an enormous influx to the Canadian tax coffers. That's why the CRA cares. Transfer pricing is low-hanging fruit as far as they can see it. It's a grey area, so they can catch onto that grey area and have a piece of that pie. So that's why they're fighting over the tax dollar. That's why the fight is there, and that's why you're here this morning, I'm sure. So I'm just going to hand it over to Lav now to get into the subject.
Thanks, Elizabeth. I'm pretty sure Elizabeth's got you all warmed up about transfer pricing. So let's just take some time now talking about the current hot topics in transfer pricing. And at the end of this segment, we'd like for you to have clarity on three important layers to transfer pricing. Planning, which is at the core of transfer pricing. It's your strong foundation. The next layer is documentation, building on a strong core. And the last layer is dispute resolution. And clearly, I mean, if you've documented your transfer pricing arrangements, it's because someone somewhere wants to audit it and see if it's all okay. So that's part of the dispute resolution. As you can see, it's like trying to build a house on a weak foundation. You know, it might look good, but it won't stand the test of time or weather. So you really need a strong core to address your transfer pricing. Let's talk about planning and hot topics. And I think transfer pricing actually starts early on in your business process, and you probably won't be even aware of it. And maybe if I asked you questions like, is cash conservation an issue for you? Is penetrating a market a strategic choice? Does the question of effective tax rate often get bounced around in conversations? Do multiple jurisdiction tax audits keep you up at night? And if the answer to any of that is yes, then actually transfer pricing planning is kind of existing in your business, and you should be thinking about it early. And this can be done in a global context. So we have what we call the OECD TP framework. The OECD is the Organization for Economic Cooperation and Development. It's a nonprofit agency that kind of lays down the principles globally accepted. And the beauty of this is, if you follow OECD principles, fairly simple. It's based on factual analysis and the concept of comparability, which is what would third parties do if they were in the same situation. And based on that, you can set your transfer pricing for global transactions. The other area that's pretty hot in transfer pricing, especially in Canada, I would say, is intercompany financing transactions. And there are two things here that's happening. One is it's clearly possible, with a bit of planning and robustness to actually achieve the desired objective on your intercompany financing. So if you've got loans cross-border guarantees, and other kind of financial transactions, you can get the desired objective in a planned fashion. And the other is the CRA's activity in this area. The CRA has a team in Ottawa focusing on financial transactions, and they've been pretty active recently. Some of you must have heard about the GE Capital case on financial transactions that came around about 2 years back. And the CRA has kind of been following that approach and trying to impose their view on how these transactions should be priced. For example, they could be looking at your intercompany agreements, and if there's a free prepayment clause in an environment of falling interest rates, the CRA might expect you to have actually prepaid and refinanced your loan when it's an intercompany loan. And you deal with some of that by actually including penalty clauses as you would in a long-term contract. So the message here is it's possible in the world of financial transactions to get the desired objective. It needs an approach, a planned approach, and it's got to be more than getting an indicative rate from your bank. So I think that's the key message here. So we've talked about planning, and I want to put a bit of reality to this and walk you through a couple of examples where planning can be used in the context of your business and how you plan for it. I've taken my first case study here is of an apparel industry retailer, and as the situation was, a Canadian retailer was expanding into the U.S., and at the time we got involved with this project, we met with the senior management, and a couple of things were really clear. The entry into the U.S. was not going to be easy. It was going to mean losses for the first few years. But if the projections were right, and if their market, was going to go in the way that they thought it would, then this would quickly become a much larger part of their business than the Canadian side of their operation. So, which means that profits in the U.S. eventually would outnumber the profits in Canada. And you'd probably ask me, what does transfer pricing have to do with this? Well, let me explain. So if you look at the opportunity and think about the fact that U.S. profits are going to be much higher than Canada, there's a tax arbitrage there. Canada at about 25%. It was slightly higher at the time when we did the planning, and U.S. at 40%. You quickly do the math, and you know where you want your profits to be in Canada. And we were able to plan around that. And it meant that applying the principles of transfer pricing and making the Canadian parent an entrepreneur in the business, and the U.S. subsidiary that they were going to establish as a low-risk entity. And that concept, I think, most business and finance people understand. I said earlier, the principles of transfer pricing are easy. More risk, more rewards. So if you've got an entrepreneur in Canada, you obviously are expecting that the profits in Canada would be higher, which means you've got your tax optimization there. Well, any kind of planning doesn't come without hurdles. So the practical implementation of what seemed like an easy plan was really the interesting part here. As many of you from the industry might know, that in the retail industry, in the apparel industry, you're buying most of your goods from overseas suppliers, primarily from China and Hong Kong. And as you can see here, if the U.S. company was buying most of their product from a unrelated party in China, there wasn't much of an intercompany transaction between Canada and the U.S. So any planning to strip profits out of the U.S. would mean that the U.S. might eventually land up paying fees that might be termed as royalties from a tax perspective. And a lot of you with the tax background know that royalties is not a good tax outcome. And more importantly, the IRS, from a U.S. perspective, might even challenge the amount of royalties. So that kind of would not work in this situation. And then we came up with the solution, which is you could easily have the third-party suppliers still invoice your Canadian parent. So if they were selling at $40, they would sell it at $40 to the Canadian parent, which is the arm's length price, third party's price. And the Canadian parent would then invoice that down at a price that would make sure that the U.S. was left with a limited but steady profit margin. And if the right answer was 5% profit in the U.S., you're left with $5 of profit on every $100 of sales that you make to a third party. And you can see easily that this outcome means that you've already captured in Canada the profits you need to. And without this, you would have had a situation where the U.S. would have been buying from the third party at $40 in this case, and leaving behind about $30 of profit in the US, which, if it didn't go back as a royalty, would have been taxed at a higher rate. So clearly a good planning opportunity. Now, I'm thinking there must be someone in the room saying, hold on, you've just probably busted the whole customs aspect on this, because you could have easily brought the goods in at $40 in the US, paid customs at $40. You're now saying to us you should be buying it at $65. Well, that's right, and we thought about that as well. In the US, you have the opportunity of what you call first sale, which allows you to bring your goods at the price of the third-party vendor, while ignoring, for lack of a better word, the tax and the financial reporting aspects. So, because this was a planned opportunity, the company was able to, maximize the benefits from both a tax and a customs perspective. And I'd almost say that without an opportunity or a structured approach, they might have realized just one of the two, but not both. And this just goes back to show that how planning can be an important aspect today in transfer pricing, especially when you're thinking about effective tax rate, cash conservation.
Love, just before you go from that, I'd just like to add a bit of color on that, because our experience on this project was quite interesting, because we came up with what we thought was an elegant customs and transfer pricing solution. And then someone from the operational side of the business walked into the room and said, hang on a minute, how does this make sense? You're introducing another transaction. This doesn't make any sense to us. The US retailer is buying, getting product from the third-party supplier. How can this be right that we're routing it through Canada? So what we learned, and actually this was at an early stage in the project, thankfully, but it's so important to have your business operational people at the table when you're having these discussions and drawing these pictures on the whiteboard, because you need your business operational people to understand why this is the right solution. It looks a bit weird to them that you're sort of routing things a different way, but once they understand the huge benefit for the business of doing it this way, that they immediately get on board, and got on board in this case, and then you've got a team who understands why you're doing it, and then can make sure that it continues to be properly implemented. Because what you don't want is a new customs guy to come in the organization and say, oh, this doesn't look right, let's change it. You need everyone in the organization to understand the model, to really understand the model at a number of levels, and be able to execute it. Because it's all very well having a great plan. If your business people decide they don't like it very much and execute something different, you don't have a great plan anymore. You've got a real problem. So making sure that the right business people are at the table when you're having these discussions is really important.
Yeah, literally we had a large table of people when we
Yes.
started the meeting.
Very large table.
Great, thanks. I'm going to move on to another example or case study, and I chose the mining industry to illustrate an example of service fees, and for two reasons. One is, mining industry is pretty native to Vancouver, but it also represents or it's representative of a lot of companies that are currently in a situation where you're headquartered in Canada. You probably don't have a lot of operations in Canada, but it's mostly outside of Canada. And this is, I want to start by saying, actually, when we look at these kind of situations, you almost think this is quite obvious, the opportunity to plan. It's almost a given. And what's been quite revealing to us over the years is that it isn't that obvious, actually, to a lot of companies. And I'm going to just take a simple example and illustrate why is it so obvious. We had a situation, a Canadian headquartered mining company, and it was increasing tax losses in Canada. Yes, obviously, if you look at it on a standalone basis, it has no revenues in Canada. All the mining was outside. And it was at a position where it was an intermediate producer, so it had started generating enough cash, profits outside where it was going to become taxable. And the solution was, well, what do we do about this? Because we're going to start paying taxes outside significantly, outside Canada. We don't have any taxable income here. How can we leverage the two? And if you look at the substance of what's happening, you have a company that is providing a service to another group company, and that's where it's the parallel universe of being in the situation of a third party. I mean, you won't expect a third-party company to provide services to another company without the expectation of getting something in return. And that's what we would call service fees, which is, a very important kind of, services provided by the C-suite and other top management in Canada. And if you see the numbers, it kind of tells you the story. I mean, Canada, before any kind of service fee, was at a 10 million loss, just taking some hypothetical numbers here. And with the recovery of service fees at 3 million, it would still be left in a loss position, which means it doesn't have any impact on your tax position. But on the other side, if you're looking at the overseas subsidiary, if their profit before the service fees was 10 million, and if you've got the right analysis and the substance, their profit after the service fees would have dropped to 7 million because you've just charged them 3 million of service fees from Canada now. Now, that means a tax difference of almost $1 million because before the service fees, they were paying 3 million of taxes, assuming a 30% tax rate, and you've now got them down to 2.1 million. It's almost $1 million of difference. And this is why it seems a bit obvious, which is you've got all these companies with legitimate reasons to be able to charge for these service fees and not capitalizing on that. Now, some of you in the audience might not associate with this situation because you might have overseas subsidiaries which are still in an exploration stage, not making money, probably not making money on both sides. And I think it's still an important planning consideration to think about service fees early on, and I'll give you two reasons for that. One is from the Canadian side, the CRA, as aggressive as they're getting, they would be still wanting to audit your tax return and look at what expenses are being claimed there, and they could easily say, well, a part of these expenses relate to business that is outside of Canada, and you should be charging for these. So they might anyway expect you to charge for this. And if you don't, then you run into a situation of possible penalties, especially when you don't have any revenues in Canada. You can easily cross the penalty threshold. And I want to get into the mechanics, but that's something to consider, that you could be offside with the CRA wanting to audit this kind of a fact pattern. But also on the other side, and a lot of companies today are operating in developing countries, especially when it comes to industries like mining. And I can speak from my own perspective, having worked in India, which was a developing transfer pricing regime at the time I was there. The mentality and the mindset of a tax officer in India was, well, you haven't charged this service fee for the last 5 years, and you're just planning to charge it now. It definitely stinks, and if it didn't seem to provide benefit for the last 5 years, why should we pay for it now? So more often than not, this is the kind of mindset you'll find in developing countries where they just don't like service fees. So if you start early on in the process and you get that into your intercompany arrangements, you've got a better chance of being able to sustain that, because if you start thinking about this when the taxes are going up, that's when it becomes an issue. So that's why thinking about this, even without having this fact pattern, is important. And again, that's an important planning opportunity from transfer pricing that you need to consider. Moving on to documentation, and I'm going to just set the context to why documentation is important and why I say a globally coordinated approach is a hot topic. Now, Elizabeth talked about this earlier. I would actually say it's been an explosion of transfer pricing, legislations across the world. I think every week I hear of a new country that's introducing transfer pricing legislation. And what's happening is across the world, as you have cross-border transactions, each of these countries have a requirement. In most cases, you'd find that taxpayers should have documentation that suitably evidences that their transfer pricing policy meets with the arm's length principle, or simply stated, it's at prices that otherwise would have been followed by third parties. And if you don't get your documentation right, you fall into a possibility of getting penalties. In some countries, penalties apply for just not maintaining documentation, whereas in others, like Canada, for instance, a penalty could apply upon an adjustment. But what's interesting about Canada when talking about documentation is that you might have a situation where you don't have the documentation, the CRA proposed an adjustment, and you were above the threshold. Now, you might still not have any impact on your tax payable because you have enough losses to soak it up. However, in Canada, your penalty applies irrespective of the tax outcome. So if the CRA has proposed an adjustment that's gone above a threshold, And if you didn't have the documentation, you could be in a penalty situation. So as you can see, with when you're trying to look at each of these countries, I mean, one good thing about transfer pricing across the world is generally you'll find countries that follow the OECD principles. As I mentioned earlier, the OECD is a body which lays out tax policy that a lot of countries will follow. But then they also have their own nuances, and documenting that and trying to meet with documentation requirements across countries can be not shocking but quite overwhelming. And if there isn't a coordinated approach, it could easily mean a lot of duplication of time and effort, and a lot of angst in the business about trying to deal with this. So, I mean, if I was to talk about nuances, Elizabeth made a good mention earlier about you could have a range in which your pricing could be right. Actually, in certain countries, you don't have the range concept that well understood. You got to have the price just right. And that's kind of not easy to comply with, or certain countries will not recognize certain benchmarking studies or your analysis because it's not been done in that country, it's been done outside. So you've got these nuances to take care of. However, given all of this, a global coordinated approach is still a better approach for various reasons. One is your business understands the principles very easily. So there's a lot of respect for your framework. People don't have to spend time reinventing the wheel. So you maximize your resources. It's efficient for the business. And more importantly, you're set up well to manage any disputes or audits that come up. And that's important in today's world. You don't have the luxury of having to spend time today on matters that are 3 or 4 years old when current issues are so important as well. So that's why documentation and a globally coordinated approach is relevant. And again, got a couple of examples here to walk you through and just to kind of show you how this can add value to your business. We've worked with a large industrial products company which has a footprint in over 10 countries. And at the time we got involved, their approach to documentation was very ad hoc. It wasn't coordinated. And as a result, they had a lot of duplication of efforts. They had the risk of non-compliance in certain countries. And there were inconsistent TP positions being taken across the globe. Everyone was trying to be a hero in the company in their own region. That just wasn't working. So the solution was we implemented a global approach, and it was suitably catered to meet local requirements. I alluded to certain nuances earlier. So when we're doing a 10-country documentation, you've got to make sure it meets with most of those countries, and then you localize it as you go along. And the outcome, which is pretty intuitive, is efficient use of resources. You've mitigated your risk of non-compliance, and you've got a central control of issues with local ownership of outcomes. And for a lot of you in this room, I think the third point probably hits home the best, because if part of your incentive of your performance management is related to how effectively you managed your global taxes and your effective tax rate, then you definitely want to have control on that and not have others have control on that. And I can best demonstrate the outcome of this kind of approach by taking an example. This company is actually being audited in virtually every country now that they operate in. You've got countries like China, which give you only 20 days to produce your documentation upon request, and it's got to be in local language. And if you just didn't get it right, you don't want to be dealing with unknown animals, in my view. And more importantly, you start spending resources and time on issues which are not important to your business at that point of time. But then the positive side of that is, in this case, as we've seen, they've been audited in so many countries. As soon as they're intimated of a new audit, well, it's not the best news for the day, but the reaction is, I'm going to call Love at PwC. I'm going to check that we've got this documentation on our shelf. Is this appropriate? Do we need to tweak it at all? Is this good to go? We talk about it for a few minutes, maybe meet up, and off you go. So it's a matter of a simple conversation, and you've got your documentation, and you've got that covered. So I think that's been a very big benefit to the company. And I want to go back and link this to how this is actually been helpful to build a strong core, because looking at it in a structured approach means that you can address your planning opportunities. And we've actually gone beyond compliance now and actually started working on optimizing the transfer pricing arrangements in their business. So till you don't get to that approach, you don't have that opportunity. And I think that's a very big tangible or an intangible benefit to your business today. And I've got another example here, and possibly a lot of you again identify with this. This could work both ways. I've just taken an example where you've got a Canadian company, a Canadian manufacturer, which is selling directly to US customers. Canadian company doesn't have any legal presence in the US, but it does have employees who go cross-border, negotiate contracts, and create a taxable presence. And the approach the approach that generally followed is, yes, we've got to file a branch tax return in the US, and it's been done using ad hoc basis, such as, let's allocate revenues, let's allocate sales, and get our branch tax return filed. And that actually, firstly, is not founded on principles. It's probably not going to give you the right outcome, and it might be tax inefficient. Now, what's happened over the last few years is that the OECD has come out with guidance specifying that and giving very clear guidance that when you've got branch situations, you can apply the principles of transfer pricing by, you have to almost fictionalize that your branch is a company, is a separate legal entity, and the dealings between your branch and your head office are then structured using transfer pricing principles. And from a US-Canada perspective, there's been a very important development 6 months back in June. Both the countries have now signed a memorandum agreeing to apply those OECD principles. So what you've got now is two tax authorities that are saying, well, we're going to use transfer pricing principles to look at your branch tax positions. And I think it's a positive thing, because in the past, for instance, if you had losses in Canada and you wanted to allocate losses to the branch in the US, well, you can almost expect the reaction from the IRS. No, we don't like the losses. You keep the losses. We just want some income here. Now, if you've got a transfer pricing approach to it and a principled approach, you can justify that position. So, it's moving beyond compliance and again kind of being a more positive planning opportunity there. And we're seeing, this is becoming again quite a prevalent hot topic in today's times, especially with US Canada.
So the outer layer of the onion, as we've said, it's best to get to the outer layer with a really, really strong core and a good layer of documentation. And if you do that, this outer layer will not be a scary place for you. But it doesn't need to be a scary place, but it is a place that you will get to. It is pretty much inevitable that if you do have cross-border transactions within your group, you will get a transfer pricing audit. It's certainly the case here in BC, where the CRA have told me a number of times that they have enough international tax auditor resources to audit every company that files a T106 in BC. So once you file a T106, it's a case of when, not if, the CRA audit starts. And it used to be the case that the same was not perhaps true on the other side of the border. In the US, I would say even 3 years ago, if I was talking to a client who has a Canada-US tax situation and transfer pricing issue, if the transaction was relatively small and, for example, the US company was loss-making, our experience was that the IRS really didn't get to those companies. The IRS had this, there was this concept of, in the IRS, of really going after the big companies. It was possible to fly below the radar screen. That has changed. And I have to say, it's very visibly changed, particularly in the last year. The IRS has, again, fermented by politically what's happening in the US, the need of the economy for tax dollars. The drive is on in the US to audit everyone. And transfer pricing it's almost a politically correct way of going after your businesses, because the tax authorities can put up their hands and say, well, I'm not going after the local company. I'm going after the company across the border that's got our profits that we should be taxing. So it's almost a way of them conducting audits in a non-offensive way to their domestic businesses, as they would put it. So you have to be aware that that's the climate. And in the US, they've really geared up their resources. There's many more international auditors on the ground, and unfortunately there is now no longer a radar screen to fly under. So still focusing on Canada-US just for a moment. There, as well as this change in audit climate, there has been, happily, a change in dispute resolution. What's happened is about 3 years ago, the Canada-US treaty was effectively amended to introduce this concept of arbitration, binding arbitration. So when you have a transfer pricing adjustment in Canada, to avoid double tax, the treaty lets you go to the US and say, give me a compensating adjustment so that I'm not paying tax on the same dollar on both sides of the border. Historically, this would then become a very long-running argument. The treaty requires the tax authorities to talk to each other and resolve the double tax, but it took years and years and years. But now what we have is something called mutually binding arbitration, so that after they've been fighting for 2 years over your tax dollar, you can say, now go and sort it out. And there's an arbitration procedure. And what we've seen since this has been in play is many more disputes getting resolved before arbitration. We've seen the arbitration procedure working. There's a number of cases have gone to arbitration and been resolved. But what's happening is it's really pushing the CRA and the IRS to figure it out before arbitration. And the reason this is happening is because the type of arbitration they're using is called baseball arbitration. I don't quite get the North American sports concept of that, but each side puts their best position on the table. The CRA put their best position on the table, and the IRS put their best position on the table, and the arbitrators choose one of them. They don't choose anything in between. They choose one of them. And this is obviously a worrying concept to both sides if they're too far apart. And they'll know if they're far apart because they've been arguing for a couple of years. So we've seen the CRA and the IRS not wanting to get there. So that's good for you. That's good for resolutions. It means that these disputes are getting resolved quicker. They're getting resolved in less than 2 years. So that's really good for you. And the other thing that's really happening as a hot topic, since a lot of the focus on tax avoidance and tax havens in the international tax world, we've seen a lot of tax information exchange agreements come into place. We've also seen some new treaties come into place. And so, for example, in 2013, we should see the ratification and coming into force of a Canada-Hong Kong tax treaty for the first time ever. So this progress is good for you as taxpayers, and it's really, particularly the Hong Kong-Canada treaty, is going to be a game changer for any of you who are doing business in Asia, because there's some optimal planning that we can do around Hong Kong. In the past, we had to do that in the context of there being no treaty. We now have a treaty. With tax treaties come two opportunities, both the resolution of double tax through these resolution procedures in the treaties, but also often and usually comes the opportunity to do advanced planning and have an advanced transfer pricing agreement, an APA, an advanced pricing agreement, which can be a mutual agreement between two tax authorities and is really the route to certainty for you as a taxpayer. So some of these developments in treaties are really important for you and, again, present great opportunities. We see advanced pricing agreements as advanced disputes resolution. It's the way of avoiding dispute resolution completely. So, again, keeping it practical, let's ask some of the questions that you might be asking about tax disputes. And the first one is natural. Why me? Why have I been picked? But I should probably add to this, why me? Why now? because, as I said earlier, these transfer pricing disputes and audits, they don't happen at a time that you control. The CRA come at a time that they get to you on their list. And when the CRA starts an audit, you have 3 months to respond to their first request for your documentation and information. So it happens because you've got cross-border transactions. As I said, it's inevitable. In Canada, we have something called a T106, which is a form which states your cross-border transactions. In the US, it's a 5471 or a 5472. And the CRA and the IRS both want that tax dollar. That's why it's you. It's very simple. It's very straightforward. So what do you do when you get the letter? And my first point here is get to work as soon as you receive notification. And that, if there's only one thing you do, do that. But again, another aspect for you as financial executives to be aware of and think about is, are you going to know about the letter? If you're in the headquarters of a multinational, you're sitting here in Canada, and your subsidiary in Korea has just received notification of a transfer pricing audit, have you got the controls and the communications and the systems in place to make sure that you find out about it immediately? It's very important that you have central control over audits that are happening in transfer pricing, that you control the documentation and the information that's being provided in answer to the tax authorities' questions. And I have seen some undesirable situations of tax and finance executives here at the Canadian parent finding about these things a bit too late. So think about your controls, think about your communication within your global finance teams to make sure that someone centrally is going to know about those audits as soon as they start. So gather and review and compile your documentation. You'd be surprised if you look hard and with the right set of eyes on it, around your organization, you do have a lot of transfer pricing documentation. You may not have a nice binder on the shelf labeled transfer pricing documentation, but when you step back and stop panicking and look around your business, you'll find that you have memos, you have intercompany agreements, you have financial information which shows how you did your pricing. If you've got cross-border transactions, you are doing transfer pricing. You may not have thought about whether or not I have an arm's length transfer pricing policy, but again, we have the concept of an arm's length range. There are a variety of methods that you can use. So at that point, if you haven't done your early work, there's probably a lot you can do. In Canada, you've got 3 months to compile. Well, you've got to work hard on compiling it, and as I say, you're not controlling the time when you're doing that, but there's a lot that you can compile. And don't expect that you can get an extension of that deadline. Certainly it's the rule in Canada that it's a statutory deadline that you have 3 months to comply with that request. It's in the law, it's in the Act. The auditor does not have discretion to extend that. So don't ask and meet the deadline. And that deadline is pretty set in stone in many of the countries that we deal with. In the US, you get 30 days. Love mentioned in China, you get 20 days. But there's always a period. It just might not be very long, and it might not be very convenient. If you get 30 days to do something and you're in the middle of year-end close, that's not going to be particularly convenient to you. So again, that's the benefit of doing your work early. And because it's early on a Thursday morning, I thought I'd focus on the best case outcome rather than the worst case outcome. I am not going to be a bringer of doom and gloom. What I've said here, no disruption, no adjustments, no double tax, no interest, no penalties, absolutely the best case outcome. And I've seen all of those things, apart from, I think, the first one, the no or minimal disruption to your operations. That is extremely rare. But the drain on resources comes from a number of different things. It comes from those information requests, which are detailed. It comes from having a CRA team camped in your office for a week, or maybe 2. For example, the way the CRA are using their resources at the moment, we've seen audit teams from Victoria come and audit clients in the city here. And when they do that, because they're using their resources that way, they'll come for a week. They're not going to come in for one day and leave and come in for another day and leave. They'll come for a week. So that's a drain on your resources. The other thing that you might experience as a drain on your resources is that the CRA will decide that they need to go and visit your operation in the United States or maybe somewhere in Europe as part of their audit. Now, this won't just be a drain on your resources in terms of your time and the time of your people who will need to be with them through that process. You will be paying for that if that happens. Now, there are ways to stop that happening, and the CRA like to be more strident about their right to do this than it is actually their right, but many taxpayers feel pushed into agreeing with the CRA's request to travel somewhere warm in the middle of winter. And we've seen this. I'm going to share a story. There was a client in this city being audited for some reason by an auditor out of somewhere in the east in the middle of winter, who decided that they needed to go and audit the operations in San Diego, which was a much nicer place to be in that particular month of February. And the CRA audit team spent a week in San Diego performing a functional analysis of the other end of the transaction. So this happens, and again, you as the taxpayer will end up paying for that if that happens. I'll take your questions if you're interested to talk more about that and how you avoid it, but that's another drain on your resources. So yes, I would say that all of the other outcomes, in terms of the best outcomes, are achievable. The drain on your resources is pretty much unavoidable, so you need to be ready for that and prepared for it. Okay, so just to wrap up, coming back to the positive, I really encourage you to see transfer pricing, cross-border transactions, as an opportunity. It's an opportunity because you can make the most of flexibility that the arm's length concept gives you. You've got flexibility in your business because you can move some things around sometimes, particularly when you're going into a new country. You can set it up optimally. So you've got some options, you've got some flexibility. Take the chance to optimize. But with a strong and optimal core plan and a good layer of documentation, you will have efficiency, you'll have effective transfer pricing, and your dispute resolution layer will be as painless as possible, which is where I want you to be. And if you've done these foundations, if you've built your core well, and you've got good documentation, you as finance executives will be in the happy position of satisfying your stakeholders. Your public shareholders will be happy, your private shareholders will be happy, and your audit committee and your board will be satisfied with how you're managing tax risk, and they'll be satisfied with how you're optimizing and taking the chances that you can take to really optimize the tax that you're paying and where you're paying it. And then your disputes will be handled with minimum disruption to your business. You don't want to be in a position of having to explain to your board that certain things in the finance department aren't getting done because you're in the middle of a really messy transfer pricing audit. So you can manage it. And from my perspective, I think you should be managing it. And I hope that with this awareness, you'll be in a position to perhaps go back to your businesses and take some steps just to think through, okay, what steps do I need to take? What should I be focusing on in the next few weeks?